Okay, hello there. My name's Nigel Moisey and a very warm welcome to this presentation, VAT for Serviced Accommodation Businesses, the Traps that Catch the Unwary, presented by Bookkeeping and Tax Compliance Solutions UK. Okay, now you can take notes as we go along, but there will be a slides download at the end of the presentation if you'd like to have them. Okay. I have to start with the usual disclaimer, I'm afraid, so here goes. While every effort has been made to provide accurate and up-to-date information in this presentation, it is provided for guidance only. The content should not be viewed as advice, but information. We accept no liability for any loss suffered as a result of your use of the information provided in the presentation. It is essential that you consult a suitably qualified professional before taking or refraining from taking any action or decision based upon the content of the presentation. The information in the presentation is based upon current law and practice, current in June 2019. Okay, so serviced accommodation. Serviced accommodation is one of the few property strategies where VAT registration may be required. Now, most SA businesses are likely to reach the VAT registration threshold sooner or later, which at the time of producing this presentation is when the business's turnover reaches £85,000 in any period of 12 months, and which is calculated by reference to a rolling 12-month total. When the threshold is breached, registration is compulsory. All businesses operated by the same person or entity are amalgamated in calculating turnover for VAT registration purposes. If you operate another business, it would almost certainly be of advantage for you to ring-fence your SA business within a separate entity. Take care, because splitting a business for the sole purpose of evading VAT is illegal. If you are to split off an SA business, there have to be good commercial reasons to do so. If the business is of a different nature to the other business or businesses carried on by you or the entity, there is usually no other reason necessary. For instance, an SA business set up by a self-employed taxi driver would be fine. If the business is similar to an existing business, for instance, an additional SA unit, there has to be a good reason. Where many SA businesses are effectively operated using management agreements, this can be difficult. However, by involving genuinely interested third parties, you may achieve the objective. But before doing so, please take advice. So let's move on and look at a couple of illustrations of monitoring cumulative turnover for an SA business. On the slide now is an illustration of a new startup SA business. For month one, it's got a gross income of £3,000, which continues through month 2, 3 and 4. In month 5, it adds a second unit, so it increases its income to £6,000 per month, which continues through month 6, 7 and 8. Then in month 9, it adds a third unit, increasing its total income per month to £9,000, which continues throughout the 24-month period on the slide. I've not added any additional expansion, which would serve no purpose as part of the illustration. Okay. As far as the cumulative figures are concerned, you can see that they jog along each month, and at the end of 12 months, they've reached £72,000. Which is the total for a year to the end of month 12. At the end of month 13, the total of £78,000 is the total from months 2 to 13. At the end of month 14, the 84,000 is months 3 to 14, and so on. Okay. The first time the business exceeds the registration limit or threshold is in month 15. It then has until the end of month 16 to notify HMRC of its liability to be registered, and will be treated as registered from the first day of month 17. From that point, it has to account for output VAT on its monthly total income. I've assumed that it can't add VAT to its monthly total income. It would price it out to the market, although for business users it may be able to. But the £9,000 monthly income is inclusive of £1,500 VAT. Now, if as with a lot of SA businesses, the work in running the business is outsourced, particularly bookings, lettings, management, and so on, it's probable that there would be up to 50% or around about 50% of turnover incurred in costs that bear deductible input VAT. So the business would then be entitled to deduct that £750 from the £1,500 on its turnover. It's got to account for on its turnover, and it would owe HMRC £750 for that month. It would pay VAT probably quarterly by roughly the end of the month following the end of each quarter. Okay, so you can see there that the VAT cost to this business is £750 per month. I haven't done a slide for the situation if it had or if it was able to increase the turnover by charging VAT to its clients, but 20% of £9,000 would mean that there would be £1,800 of extra income by way of output VAT. So it would have to account for that £1,800 to HMRC. So that would be totally neutral, because it would collect 1,800 extra and account for 1,800. It would then set off the input VAT against the 1,800 and only pay 1,050. So it would actually be gaining by £750 per month. Okay, it would be receiving £1,800 extra per month, but only paying out £1,050 per month. So would be gaining the £750 per month. Okay. Let's move on and quickly look at a business where there's an existing business at the time the SA is started up, and I've included this existing business running at a constant income of £5,000 per month. So that means that the monthly income total on the commencement of the SA becomes £8,000 per month. And I'm not going to run through this line by line again, but you'll see that all these figures are £5,000 or £5,000 per month greater than they were in the previous slide. The addition of that £5,000 per month means that the threshold is exceeded in month 9. HMRC should be notified by the end of month 10, and VAT will be accountable from the first day of month 11. In this case, the income is £14,000, which, as an inclusive of VAT amount, gives rise to a liability of £2,333 due to HMRC. I've allowed £750 again input tax relating to the SA business and £250 relating to the existing business, making a net £1,333 owed to HMRC each month, a total of £3,999 per quarter, payable by at or around about the end of the month following the end of the quarter. Okay, I think all that makes sense. Similar remarks arise as to the situation if VAT could be added by the business, by the existing business, by the SA, or by both. Assuming that VAT could be added by both, the £14,000 would give rise to a VAT charge of £2,800, so the gross receipts would go up to £16,800. The £2,800 would be accounted for to HMRC. By deduction of the £1,000 per month, the payment would only be £1,800 per month. So by adding the VAT, there would actually be an advantage to being VAT registered of £1,000, the 2,800 due would be charged as an additional amount to the client, so would be neutral. The input tax offset would effectively be additional profit. So registration in that situation would be beneficial. Okay. Now let's move on to long stay income. For long stay guests, from the 29th night, there is no VAT on the charge for accommodation. VAT is then due on only any meals, drinks and service charges provided and any other facilities provided, apart from the right to occupy the accommodation. The minimum amount upon which VAT is payable is actually the higher of the combined total of the meals, drinks and so on and the other facilities, and 20% of the total charge to the guest. That means that for most SA businesses, they will pay VAT on only 20% of long stay income. Let's have a look at a couple of illustrations of the relief for long stay guests. Okay, now I've applied it to the £3,000 takings. Obviously not all guests may be eligible for the long stay treatment. I don't want to fiddle about splitting income, overcomplicating matters for the sole purpose of illustration. So the first illustration here is based on calculations based on VAT exclusive charges, but where VAT is actually charged in addition to the accommodation charges. Okay, so the takings of £3,000 are the net amount. £600 of VAT has also been charged. Okay, as we've discussed, there's no charges for meals. The value of facilities and meals together have to be at least 20% of the takings, net of VAT takings, that is. So that is £600, and the VAT applicable to £600 is £100. So out of the gross income of £3,000 plus £600 VAT, that's £3,600. Only £100 has to be paid over to HMRC, leaving a net £3,500 to the business. If there was no long stay relief, that net amount would have been the £3,000 net of VAT takings. Okay, so there's an advantage of £500 to the business. That can also be looked at based on VAT inclusive charges. So if we started with the £3,600, that's the £3,000 in the first illustration plus the VAT. There's no charge for meals again. All we do then is take the VAT off. Okay, so we've got a VAT exclusive amount. Then we evaluate the facilities at 20% of that VAT exclusive amount, and again we get £100 VAT due. So again, the net income after payment of VAT is the gross £3,600 less the £100 paid, which is £3,500. Again, compared to the £3,000 net income if no long stay relief. Finally, and what is probably the most likely applicable situation, is where the takings of £3,000 a month, where you can't charge extra for VAT but have to absorb it. Okay, so what we do here is say, right, these takings are inclusive of a VAT. The inclusive amount is £500. Okay, that's 1/6 of £3,000, which gives £2,500 net, and as you see, £500 is 20% of 2,500, the normal VAT rate. Okay, we then say that 20% of the net amount is applicable for the minimum charge for facilities and so on, and the VAT amount included in that 500 is £83. So in this circumstance, we would pay £83 to HMRC, leaving us with £2,917 out of our £3,000 headline figure, compared to what would have been £3,000 less the £500 VAT. so £2,500 without the long stay treatment or relief. So we've actually gained £417 here by application of the long stay rules. Okay. Now, one or 2 points to take into account. Stays must be continuous. Breaks in stays bring the long stay period to an end. So then the relief is not available until a further continuous period of over 28 days arises. That's the case even for occasional weekends away. You can prevent the break if the guest has a continuing right to occupy the room or a similar room in the same establishment throughout the period when they're absent. In many cases where contractors are in occupation during the week but go home at weekends, they could have the right to occupy during the weekend. It needn't be the same room but an equivalent one in the same establishment. Even if the room is then let to third parties during the weekend, there is no break in the long stay. Where bookings are made for staff or contractors by the employer company, although the bookings may be for an extended period that would be eligible for the long stay relief, it is the individual guests that count. If the occupants change or rotate on a frequent or regular basis, unless there is at least one occupant qualifying for the long stay relief, it is lost. At least one of the occupants must at all times be eligible for the relief in shared accommodation. If let on a room-by-room basis, it would be only the rooms occupied by the qualifying occupants eligible for relief. But if a single let, such as a flat or house, provided one occupant is eligible, the whole property may also be eligible. This is a complex area, so please take advice. So let's move on to the flat rate scheme. This is a simplified VAT regime for small businesses where they pay a reduced rate of VAT, which is applied to the gross turnover including VAT, but apart from certain exceptions are then ineligible to deduct input VAT. The certain exceptions where VAT may remain deductible are capital expenditure on assets in excess of £2,000 when purchased on the same contract. Okay, that VAT would remain deductible. The flat rate applicable to hotels and accommodation is 10.5%. That would be unlikely to provide any great advantage to those who outsource bookings and management. It may be advantageous to those who deal with those aspects of the business themselves, so have comparatively few expenses bearing input tax which they can deduct in arriving at the amount they owe HMRC. Now take care, because the flat rate scheme applies to all income of the registered individual or entity, which includes income that may otherwise be exempt or taxed at a reduced rate or the zero rate. For example, with a mixed-use property where the upper floors are let as SA and the ground floor is let as a commercial unit, the rent for the ground floor, which would otherwise be exempt, would become taxable as part of flat rate scheme income. There is an exception where the ground floor commercial unit may not be exempt, where possibly the registered entity or individual has elected to opt to tax in respect of the property, but that's outside the scope of this presentation. Okay. The other situation is where VAT relief is available for long-term stays. That income would also become liable at the applicable flat rate. Okay. So now it's summary time. Don't forget that when comparing the rolling 12-month turnover to the VAT registration threshold, you should take into account other business income of the same person or entity. Due to that and the particular peculiarities of the application of VAT to SA, it's generally advantageous to operate the SA business in a separate entity. However, you must have due regard to HMRC's attitude to business splitting. Then, with long stay guests, you can prevent breaks in continuity by giving them the right to occupy throughout periods of absence. That right has to be a contractual right. And finally, don't get caught out by the flat rate scheme, which could result in exempt, zero rated or long stay income becoming taxable at the flat rate. Finally, always take appropriate professional advice, which should take account of your particular priorities and circumstances. And with that, many thanks for watching, and I hope to speak to you again soon. If you'd like to discuss any point with me, you're welcome to do so using the contact information below.